So what if I told you the absolute fastest way to kill your Forex IB business is to just accept the highest commission rate you're offered?
Yeah, uh, that sounds totally counterintuitive, but it's honestly so true.
Right. So today we are doing a deep dive into the mechanics of introducing broker programs. And if you're listening, you probably already know the basic setup. You bring the traders and the broker executes the trades.
Exactly. I mean, they do all the heavy lifting.
Yeah. But our mission today is uncovering what separates a fleeting side hustle from a scalable, durable partner business.
Hmm.
Okay, let's unpack this.
Yeah.
Because since you aren't managing the trading infrastructure yourself, the immediate make-or-break question is, well, how you structure your payouts.
Well, the payout model you choose really dictates your entire business architecture. You generally see like three main structures out there. First, you have fixed payouts per lot traded, which are super predictable.
Okay, yeah, that makes sense.
Right. Second is spread or revenue sharing, where your income ties directly to the broker's commercial structure. And finally, there are hybrid models with CPA or cost per action incentives that pays a lump sum when you acquire a qualified funded client.
Looking at the data, though, that hybrid model honestly feels like a massive trap.
Yeah.
I mean, taking a front-loaded CPA payout is like flipping a house. You get the cash now, but you are, constantly hunting for the next property.
That is a really great way to put it.
Right. Whereas building up recurring revenue through a spread share is like owning a rental property. It totally aligns your incentives with the broker.
But hold on, let me challenge this. If I'm an IB with high traffic, shouldn't I just hunt for the highest headline CPA I can find? Like if broker A offers me $500 a head and broker B offers 200, taking broker A seems like a no-brainer.
See, what is fascinating here is that commission rates are actually a terrible first filter.
Hmm.
Going with a weak broker offering an aggressive $500 CPA is significantly harder to scale.
Wait, really? Why is that? Because high upfront payouts often mask weak platform appeal. I mean, experienced traders demand familiar lightning-fast interfaces. They want industry standards like MetaTrader 4 or MetaTrader 5 or CTrader.
Ah, I see. So if the platform is clunky, they just bail.
Exactly. If your high-paying broker has delayed order execution or a nightmare onboarding process, your clients churn before they hit the trading thresholds you need to even unlock that CPA payout.
Okay, so if chasing the highest CPA is a trap and platform reliability is what actually keeps your users trading, then your entire marketing strategy has to completely shift. Like you have to move from just blasting referral links to actively vetting for user fit.
Yeah, and that is the most common pitfall for scaling IBs. They prioritize raw registration volume over funded active clients.
Which just creates noise, right?
Totally. A funnel optimized for cheap clicks is just noise. You might pull in, say, 1,000 signups, but if those users hit friction during onboarding and never deposit funds, your acquisition cost is just entirely wasted.
Here's where it gets really interesting, though. Analyzing top-tier IBs reveals a very clear formula for durable businesses. Trust gets the first conversion, but process keeps the revenue moving.
Process is literally everything.
Yeah, if you have ever watched 100 leads convert into zero funded accounts, this is why. Sometimes your users do not need a 20-page PDF guide on market analysis. They just need, less friction during the identity verification process.
Right, and strong IBs stop pushing generic pitches. They start framing offers around the trading environment itself. Monaxa is a prime example of this ecosystem approach.
Oh, yeah, they have everything under one roof.
Exactly. Instead of selling one isolated product, they house Forex and CFDs, which, allow users to trade price movements without owning the underlying asset, and PM accounts where investors can passively allocate funds to a master trader.
It is totally like operating a world-class casino. You want the players to stay inside the building. If they get bored of the slot machines, you don't want them leaving for a different casino down the street.
You want them walking over to your poker tables.
Exactly. You give the beginner a simple copy trading setup, and you point the veteran trader toward the high-leverage CFD account. So, what does this all mean for you listening to this deep dive? The ultimate takeaway is that an IB program is a highly targeted business model. It is not a passive link drop.
Right. Your value is not your referral code.
Exactly. Your value is your access and your guidance and your relevance to your specific community.
If we connect this to the bigger picture, the smartest question isn't which program pays the most today. The question you really have to ask is which program gives your audience the strongest, most frictionless reason to stay for the next 12 months.
Think about those rental properties. You want tenants who love the building so much they never want to move out. So here's a final thought to leave you with today. Trading audiences are constantly fragmenting into highly specific, hyper-niche communities. What untapped audience could you guide better than a massive generic brokerage ever could?